Welcome to our CMA Part 1 preparation playlist with Pixel Plus. Hi everyone, and thank you for joining us on this journey to mastering the CMA Part 1 syllabus. Whether you're new to the Certified Management Accountant program or looking to brush up on your skills, you're in the right place. In this series, we'll be breaking down the entire Part 1 syllabus, covering everything from external financial reporting decisions to planning, budgeting, and forecasting. Each lecture is designed to give you a comprehensive understanding of the key concepts and help you tackle the exam with confidence. Before we dive in, make sure to subscribe to our channel and hit the notification bell so you don't miss any of our upcoming lessons. Now, let's get started and take the step towards your CMA certification success. Accounts receivable, AR, is a fundamental component of a company's balance sheet, representing the money owed to the company by its customers for goods or services delivered but not yet paid for. This account is classified as a current asset, as it is expected to be converted into cash within a year. The process begins when a company extends credit to its customers, allowing them to purchase products or services on account. These transactions are recorded in the accounts receivable ledger, which tracks the outstanding amounts owed by each customer. Effective management of accounts receivable is crucial for maintaining healthy cash flow. This involves issuing timely and accurate invoices, monitoring outstanding balances, and implementing a structured collections process to ensure timely payments. Regular reconciliation of the accounts receivable ledger with the general ledger is essential to ensure accuracy. Additionally, companies often analyze the accounts receivable turnover ratio, which measures how efficiently they are collecting receivables. Poor management of accounts receivable can lead to cash flow problems, increased bad debts, and ultimately affect the company's financial stability. Therefore, implementing strong credit policies and maintaining effective communication with customers are key practices in managing accounts receivable efficiently. Debtors are individuals or entities that owe money to a company for goods or services provided on credit. In the context of business accounting, debtors are recorded in the accounts receivable section of the balance sheet, representing the outstanding amounts that the company expects to receive. These amounts are considered current assets because they are typically due within a short period, usually within a year. The process of identifying and managing debtors begins when a company extends credit to its customers, allowing them to purchase products or services with the agreement to pay at a later date. Each debtor's account is tracked in the accounts receivable ledger, detailing the amounts owed, the due dates, and any payments received. Effective debtor management is crucial for maintaining a healthy cash flow and financial stability. This involves setting clear credit policies, conducting credit checks before extending credit, issuing timely and accurate invoices, and following up on overdue accounts. Companies may also employ strategies such as offering discounts for early payments or setting up installment plans to encourage timely payments. In summary, debtors play a significant role in a company's financial operations, and effective management of debtor accounts is essential for ensuring that the company maintains a steady inflow of cash to support its ongoing activities and growth. The process and management of accounts receivable, AR, are critical for ensuring a steady and timely inflow of cash, which is essential for the financial health of a company. The process typically involves several key steps. 1. Issuing invoices. The AR process begins with the issuance of invoices to customers. Once goods or services have been delivered, an invoice is generated, detailing the amount owed, payment terms, and due date. Accurate and prompt invoicing is crucial, as any delays or errors can disrupt cash flow. 2. Tracking payments. After invoices are issued, it is important to monitor and track payments. This involves recording the payment status of each invoice, noting whether it has been paid, partially paid, or remains outstanding. Effective tracking requires a well-organized accounting system that can provide real-time updates on the status of receivables. 3. Managing collections. Ensuring that payments are received on time involves managing collections actively. This includes sending payment reminders to customers as the due date approaches or if the payment is overdue. Communication can be via email, phone calls, or automated reminders. Establishing a consistent follow-up process helps in reducing the number of overdue accounts. For credit management, before extending credit to customers, it is essential to assess their creditworthiness. This can involve credit checks, setting credit limits, and defining payment terms that align with the customer's ability to pay. Good credit management reduces the risk of bad debts and ensures that only reliable customers are given credit. 5. Collections strategy. For overdue accounts, having a structured collections strategy is vital. This might include escalating communication efforts, negotiating payment plans, or, in some cases, involving collection agencies. The goal is to recover the outstanding amounts while maintaining a positive relationship with the customer. 6. Reconciliation. Regular reconciliation of the accounts receivable ledger with the general ledger ensures that all transactions are accurately recorded. This helps in identifying discrepancies and ensuring the integrity of financial records. 7. Reporting and analysis. Regular reporting and analysis of accounts receivable help in assessing the efficiency of the AR process. Key performance indicators, KPIs, such as the accounts receivable turnover ratio, days sales outstanding, DSO, and aging reports provide insights into how effectively the company is managing its receivables. By diligently following these steps, companies can ensure timely cash inflows, maintain healthy cash flow, and reduce the risk of bad debts. Effective AR management also contributes to better customer relationships and overall financial stability. Efficient management of accounts receivable, AR, significantly impacts a company's financial health in several key ways. Improved cash flow. Timely collection of receivables ensures that the company has the necessary cash to meet its short-term obligations, such as paying suppliers, employees, and other operational expenses. When cash flow is steady, the company can operate smoothly without needing to rely on external financing, which might incur interest costs and other fees. Consistent cash inflow allows the business to reinvest in growth opportunities, such as new projects, marketing efforts, or capital expenditures. Reduced bad debt risk. Effective AR management involves careful credit assessment and monitoring of customer accounts. By extending credit only to reliable customers and following up on overdue payments promptly, the company minimizes the risk of bad debts amounts that are unlikely to be collected. Reducing bad debts protects the company's earnings and ensures that its revenue is not diminished by uncollectible accounts. Enhanced financial stability. A well-managed AR system contributes to the overall financial stability of the company. It ensures that there are no significant fluctuations in cash flow, which can be disruptive. Stable financial health means the company can withstand economic downturns, manage unexpected expenses, and take advantage of strategic opportunities when they arise. Better financial planning and forecasting. Efficient AR management provides accurate and timely information about the company's receivables. This data is crucial for financial planning and forecasting, helping the company predict future cash flows and make informed decisions about budgeting, investments, and strategic planning. Increased profitability. By reducing the costs associated with bad debts and maintaining a steady cash flow, the company can increase its profitability. Efficient AR management also means less reliance on borrowing, which reduces interest expenses and enhances net income. Enhanced customer relationships. Efficient AR management often involves clear communication and professional interactions with customers regarding payment terms and expectations. This can lead to improved customer satisfaction and loyalty, as customers appreciate transparent and fair credit practices. Positive customer relationships can translate into repeat business and referrals, further contributing to the company's financial success. In summary, efficient AR management is essential for maintaining a healthy cash flow, reducing the risk of bad debts, and ensuring overall financial stability. By implementing robust AR practices, a company can strengthen its financial position, improve profitability, and support long-term growth and success. Allowances for accounts receivable, also known as a bad debt allowance, is a financial reserve that a company sets aside to cover potential losses from accounts receivable that may not be collected. This allowance represents an estimate of the amount of receivables that the company expects to be uncollectible due to customer defaults, bankruptcies, or other reasons. The purpose of the allowance for accounts receivable is to present a more accurate picture of a company's financial health by recognizing that not all receivables will be collected. This conservative accounting practice helps in accurate financial reporting. By estimating and recording potential losses from uncollectible accounts, the company can provide a more realistic view of its financial condition in its financial statements. This ensures that the reported net accounts receivable reflect the amount that is likely to be collected. Risk management. Establishing an allowance for doubtful accounts helps the company manage the risk of bad debts. It ensures that potential losses are anticipated and accounted for, rather than coming as a surprise in future periods. Compliance with accounting standards. The use of an allowance for accounts receivable aligns with generally accepted accounting principles, GAAP, and International Financial Reporting Standards, IFRS. These standards require companies to account for estimated uncollectible receivables to prevent overstatement of assets and income. Informed decision-making. Having a clear understanding of the potential impact of bad debts allows management to make more informed decisions regarding credit policies, customer relationship management, and overall financial strategy. Financial stability. By recognizing and planning for potential losses, the company can better manage its cash flow and maintain financial stability. This proactive approach helps in avoiding sudden financial strain caused by unexpected bad debts. In practice, companies estimate the allowance for doubtful accounts using methods such as the percentage of sales method or the aging of receivables method. These estimates are based on historical data, industry averages, and specific information about individual customers. The allowance is then recorded as a contra-asset account on the balance sheet, reducing the total accounts receivable to reflect the estimated collectible amount. In summary, the allowance for accounts receivable is a critical accounting tool that helps companies anticipate and manage potential losses from uncollectible accounts, ensuring accurate financial reporting and maintaining financial stability. Estimating and managing the allowance for accounts receivable involves a systematic approach to ensure that potential losses from uncollectible accounts are accurately reflected in financial statements. Companies use several key factors to estimate this allowance, including historical data, customer creditworthiness, and economic conditions. Here's how each factor contributes to the estimation and management process. Historical data. Companies analyze past records of receivables and bad debts to identify trends and patterns. Historical data provides insights into the typical percentage of receivables that become uncollectible over time. This information is used to calculate an average bad debt rate, which can be applied to current receivables to estimate the allowance. Customer creditworthiness. Evaluating the creditworthiness of customers is crucial for estimating the allowance for doubtful accounts. Companies assess the financial health, payment history, and credit ratings of their customers to determine the likelihood of default. Customers with poor credit histories or financial instability are more likely to default, and higher allowances may be needed for such accounts. Economic conditions. The broader economic environment can significantly impact a company's ability to collect receivables. During economic downturns or recessions, the risk of defaults may increase as customers face financial difficulties. Conversely, in a strong economy, the risk may be lower. Companies adjust their allowances based on current and anticipated economic conditions. Aging of receivables method. This method involves categorizing receivables based on the length of time they have been outstanding. Receivables are grouped into age brackets, example 30 days, 60 days, 90 days past due, and different loss rates are applied to each bracket based on historical collection rates. Older receivables typically have a higher likelihood of becoming uncollectible and are assigned higher loss rates. Percentage of sales method. Another common method is to estimate bad debts as a percentage of total sales. This percentage is derived from historical bad debt experience and applied to current sales to determine the allowance. This method is simpler but may be less precise than the aging of receivables method. Regular review and adjustment. Companies must regularly review and adjust their allowances for accounts receivable to ensure accuracy. Changes in customer circumstances, economic conditions, or company policies may necessitate adjustments to the allowance. Regular monitoring and reassessment help maintain accurate financial reporting. Implementation of credit policies. Effective credit policies and procedures help in managing the risk of bad debts. By setting credit limits, requiring credit checks, and establishing clear payment terms, companies can minimize the likelihood of extending credit to high-risk customers. Strong credit management practices contribute to more accurate estimation of the allowance for doubtful accounts. Properly managing the allowance for accounts receivable is crucial for maintaining realistic asset values, protecting against unexpected losses, and ensuring a more accurate financial picture. Here are the key ways in which effective management of this allowance impacts a company's financial health. Realistic asset values. The allowance for accounts receivable reduces the gross amount of receivables to reflect only those amounts expected to be collected. This adjustment ensures that the asset values reported on the balance sheet are realistic and not overstated. Accurate asset valuation is critical for stakeholders, including investors, creditors, and management, as it provides a true picture of the company's financial position. Protection against unexpected losses. By setting aside a reserve for potential bad debts, companies are better prepared to absorb the impact of uncollectible accounts. This proactive approach mitigates the risk of unexpected financial strain caused by customer defaults, helping to stabilize the company's earnings and cash flow. The allowance acts as a financial cushion, protecting the company from the adverse effects of bad debts. Accurate financial picture. Proper management of the allowance for accounts receivable contributes to more accurate financial reporting. When the allowance is correctly estimated and adjusted, the company's financial statements, particularly the balance sheet and income statement, more accurately reflect the company's financial health. This accuracy is essential for making informed business decisions, securing financing, and maintaining investor confidence. Enhanced credibility and transparency. Consistently applying a methodical approach to estimating and managing the allowance for doubtful accounts enhances the credibility and transparency of the company's financial reporting. Stakeholders are more likely to trust the financial statements when they see that the company takes a disciplined approach to managing its receivables and potential risks. Improved financial planning and decision-making. Accurate allowances allow for better financial planning and forecasting. Management can make more informed decisions about budgeting, investments, and resource allocation when they have a clear understanding of the potential risks associated with receivables. This clarity aids in strategic planning and helps ensure the company's long-term financial stability. Compliance with accounting standards. Proper management of the allowance for accounts receivable ensures compliance with accounting standards such as GAAP, Generally Accepted Accounting Principles, and IFRS, International Financial Reporting Standards. These standards require companies to account for estimated uncollectible receivables to prevent overstatement of assets and income. Compliance with these standards is essential for maintaining regulatory standing and avoiding potential legal and financial penalties. Sustained profitability. By minimizing the impact of bad debts through accurate allowances, companies can sustain profitability. Fewer unexpected write-offs mean that more of the company's revenues translate into actual profits. This sustained profitability supports the company's growth and operational objectives. The allowance method involves estimating uncollectible accounts at the end of each accounting period and creating an allowance for doubtful accounts, which is a contra-asset account that reduces the total accounts receivable. This method aligns with the matching principle of accounting, ensuring that expenses related to bad debts are recognized in the same period as the related revenues, providing a more accurate reflection of the company's financial performance. Estimation techniques. Percentage of sales method. This technique estimates bad debts as a fixed percentage of the total credit sales for the period. Historical data on past sales and bad debts are used to determine the appropriate percentage. For example, if a company has historically experienced a 2% bad debt rate on credit sales, it will apply this percentage to current period sales to estimate the bad debt expense. Aging of receivables method. This method involves categorizing accounts receivable based on the length of time they have been outstanding. Receivables are grouped into age brackets, example 0 to 30 days, 31 to 60 days, 61 to 90 days, over 90 days, and different percentages are applied to each bracket based on historical collection rates. Older receivables, which are less likely to be collected, are assigned higher percentages. This technique provides a more detailed and accurate estimate of potential bad debts by considering the age of each receivable. Financial reporting. Using the allowance method ensures that accounts receivable are reported at their net realizable value on the balance sheet. The net realizable value is the amount of receivables expected to be collected after accounting for estimated bad debts. This approach provides a more accurate and realistic picture of a company's financial position by recognizing that not all receivables will be collected. It also enhances the reliability and credibility of financial statements by presenting a true and fair view of the company's assets. In summary, the allowance method, through the use of estimation techniques like the percentage of sales method and the aging of receivables method, ensures accurate financial reporting by reflecting accounts receivable at their net realizable value. This method supports better financial planning and decision-making by providing a realistic assessment of the company's expected cash inflows. Historical loss rate method. The historical loss rate method relies on historical data to estimate future credit losses. This approach involves analyzing past trends and loss rates to predict the percentage of receivables likely to become uncollectible. Here's how it works in detail. 1. Data collection. Collect historical data on credit sales and the corresponding bad debts over a relevant period, typically several years. 2. Calculate historical loss rates. Determine the loss rate for each period by dividing the total bad debts by the total credit sales for that period. For example, if a company had $10,000 in bad debts and $500,000 in credit sales in a given year, the loss rate would be 2%. 3. Average historical loss rate. Compute the average loss rate over multiple periods to smooth out any anomalies and provide a reliable estimate. This average rate is used to estimate future bad debts. 4. Apply to current period. Multiply the average historical loss rate by the current period's total credit sales to estimate the allowance for doubtful accounts. For instance, if the average loss rate is 2% and current credit sales are $600,000, the estimated bad debt expense would be $12,000. This method assumes that future credit losses will follow the same pattern as historical losses, making it effective in stable economic conditions but potentially less accurate during periods of economic change. Aging of receivables method. The aging of receivables method categorizes accounts receivable based on how long they have been outstanding, with older receivables considered more likely to be uncollectible. The process includes 1. Classify receivables by age. Sort receivables into categories based on the length of time they have been outstanding, example 0 to 30 days, 31 to 60 days, 61 to 90 days, over 90 days. 2. Determine historical collection rates. Analyze historical data to determine the likelihood of collection for each age category. For example, historical data might show that 98% of receivables less than 30 days old are collected, but only 60% of receivables over 90 days old are collected. 3. Assign loss rates to each category. Based on historical collection rates, assign higher loss rates to older receivables. For example, if the historical loss rate for receivables 0 to 30 days old is 2%, for 31 to 60 days old it might be 5%, for 61 to 90 days old it might be 10%, and for over 90 days old it might be 20%. 4. Calculate estimated bad debts. Multiply the outstanding amount in each category by the assigned loss rate. Sum these amounts to determine the total allowance for doubtful accounts. For instance, If a company has $50,000 in receivables aged 0 to 30 days, $30,000 aged 31 to 60 days, $20,000 aged 61 to 90 days, and $10,000 over 90 days, the estimated bad debts would be calculated as follows. 0 to 30 days, $50,000 asterisk 2% equals $1,000. 31 to 60 days, $30,000 asterisk 5% equals $1,500. 61 to 90 days, $20,000 asterisk 10% equals $2,000. Over 90 days, $10,000 asterisk 20% equals $2,000. Total allowance for doubtful accounts equals $1,000 plus $1,500 plus $2,000 plus $2,000 equals $6,500. Expected credit loss model. The expected credit loss, ECL, model, as mandated by accounting standards like IFRS 9, requires companies to estimate credit losses based on a forward-looking approach. This model incorporates current conditions, historical data, and reasonable forecasts of future economic conditions. Here's a detailed look at the approach. 1. Identify exposure at default, EAD, determine the amount at risk if the customer defaults. This includes the outstanding receivable amount and any undrawn credit lines that the customer might use before defaulting. 2. Probability of default, PD, estimate the likelihood that the customer will default within a given period. This estimate is based on historical default rates, current customer credit ratings, and economic conditions. 3. Loss given default, LGD, estimate the percentage of the receivable that would be lost if the customer defaults. This considers any recoveries, such as collateral or guarantees, that could mitigate the loss. 4. Incorporate forward-looking information, adjust PD and LGD estimates to reflect current and anticipated future economic conditions. This involves using economic indicators like GDP growth rates, unemployment rates, and industry-specific trends. 5. Calculate expected credit loss, combine EAD, PD, and LGD to calculate the expected credit loss. The ECL model provides a more accurate and dynamic estimate of credit losses by considering a broader range of factors and adjusting for changing economic conditions. This forward-looking approach helps companies better anticipate and prepare for potential credit risks. Reinstatement of accounts receivable. When a company collects a previously written-off account, the first step is to reinstate the account by reversing the write-off entry. This process involves 1. Reversing the write-off entry. The original write-off entry typically involved debiting bad debt expense and crediting accounts receivable. To reverse this, the company will debit accounts receivable, to restore the amount owed by the customer on the books. Credit allowance for doubtful accounts, to reverse the previous charge against the allowance. Example entry: debit, accounts receivable. Credit, allowance for doubtful accounts. This reinstates the accounts receivable on the company's books, reflecting the receivable as if it had never been written off. Recording the cash collection. After reinstating the account, the company then records the actual collection of cash from the customer. This involves 1. Recording the cash received. The company records the receipt of cash by debiting the cash account, to increase the cash balance. Crediting the accounts receivable account, to reduce the amount owed by the customer. Example entry: debit, cash. Credit, accounts receivable. This entry effectively clears the reinstated accounts receivable, reflecting the collection of the outstanding amount. Impact on financial statements. The collection of a previously written-off account has several positive impacts on the company's financial statements. 1. Improves cash flow. The collection increases the company's cash balance, improving liquidity and providing more funds for operations, investments, or debt repayment. 2. Reduces bad debt expense. The reversal of the write-off reduces the bad debt expense recorded earlier. Although the initial write-off increased the bad debt expense, the subsequent recovery and reinstatement of the receivable reverse this effect, leading to a net reduction in bad debt expense over time. 3. Balance sheet impact. Accounts receivable. The reinstatement of the receivable temporarily increases the accounts receivable balance, but this is offset by the subsequent collection, which reduces it back to zero. Cash. The cash collection increases the cash balance, enhancing the company's overall asset position. 4. Income statement impact. Bad debt expense. The reversal of the write-off reduces the bad debt expense, potentially improving net income for the period if the reversal occurs in the same fiscal year as the write-off. Net income. By reducing the bad debt expense, the reinstatement and collection can improve net income, reflecting better overall financial performance. Collection of accounts previously written off. The entire process involves two main steps: reinstating the written-off account and recording the cash collection. Here is a detailed example. Example scenario asterisk. A company initially wrote off a $1,000 receivable as uncollectible. Later, the customer pays the $1,000. 1. Reversing the write-off entry. Debit, accounts receivable $1,000. Credit, allowance for doubtful accounts $1,000. 2. Recording the cash collection. Debit, cash $1,000. Credit, accounts receivable $1,000. The financial impact includes improved cash flow, an additional $1,000 in the cash account, a reduction in the bad debt expense, and a positive effect on both the balance sheet, increase in cash, decrease in receivables, and the income statement, potential increase in net income due to the reduction in bad debt expense. This process ensures that the company's financial records accurately reflect the recovery of previously written-off receivables, enhancing overall financial health.
So that's it for our today's class. Thank you for watching, and if you found this video helpful, don't forget to give it a thumbs up and share it with your friends. For more in-depth CMA course content and updates, make sure to hit the subscribe button and click the bell icon so you can never miss an upload. Do you have any questions or topics that you would like to cover? Leave a comment below and I will be sure to get back to you. Follow us on our social media channels for additional tips, resources, and community support. Thank you again for your support. Keep learning and see you in the next video. Thanks for the watching.